Hello. Yeah, Rakesh, you are able to see my PPT and hear me also? Both, right? Thank you. So we'll start. Sorry, I got late. Huge traffic in between. We'll straight away start. Now we are into the last chapter of the module 6, which is a part of section B, and we were looking into the just a second. We were looking into the various laws and compliances that are expected in business valuation. Because again, the business valuation has to be done within a legal framework only, and depending on the end purpose, what it is, accordingly the valuation has an impact. So these are the various chapters that we covered. Today we will see the 5th chapter, which is the last chapter, or called as valuation standards. Now what is meant by valuation standards? So typically let's have an overview of what is meant by international valuation standards. So definition wise, the IVS, in short, what I will be calling, are globally recognized guidelines. So these are guidelines that define how valuation assignments should be conducted by the various professionals who are eligible to do valuation. Just a second, Rakesh. There is some issue with the screen for the OBS. आविष्कार, पुष्कराज जोशी बोलतोय. हॅलो, आहात का तुम्ही ऑफिसमध्ये? जरा वर येऊ शकतोस, कारण का ओबीएस मध्ये माझा चेहरा दिसतोय, ते प्रेझेंटेशन दिसतच नाहीये. जरा ये ना प्लीज. टाकली गेलं 15-20 वेळा करून झालं. काय कधी येतं कधी जातं. 15 वेळा केलं. ॲक्टिवेट डिॲक्टिवेट. ते काय युजर फ्रेंडली आहे की काय? ठीक आहे, थँक्स. पण मी दिसतच राहणार का आता? रेकॉर्डिंगला पण मी दिसत राहणार. So I have to be cautious. Okay, yeah Rakesh, sorry, there was this issue. हे आविष्कार Rakesh and Anu, can you give me a thumbs up if you are able to hear me and see the presentation also? Anu? Yeah, perfect. Thanks. Great. Sorry. Yeah. So we'll start. Anu, good that you joined. We haven't started. I was a bit late because of the traffic. So we are looking into the last chapter of the module 6, which is about, so again I am surprised by the institute also. The 5 chapters have been just given a weightage of 5 marks. So I don't know why the legal framework and regulatory framework on business valuation has been given such a less percentage, but otherwise the chapters are big, looking at the provisions and everything. So maybe it's more of the overview that you are supposed to know about the business valuation legal framework, and that's why that much of the weightage. But as a professional, you need to know the legal framework thoroughly, and with that intent, let's start with the chapter 5 on valuation standards. So overview of, so there are like the way we have IFRS for accountants, international financial reporting system, or generally accepted accounting principles as such, which is called as GAAP, so US GAAP, etc., which mandates internationally how the accounting has to be done of various aspects. Accordingly, valuation standards also have been set and have turned out to be recognized guidelines globally that define how valuation assignment should be conducted by the valuation professionals. Now, who are the valuation professionals, etc.? We have already covered in the previous chapters, and more specifically, the registered valuers and valuation rules have prescribed which examination, who can do what sort of asset valuation, etc. has been already covered. Now, this is more on the international valuation standards, the entire chapter, that is IVSC. So, IVSC is the International Valuation Standards Council, that is the governing body. So like the way for US GAAP we have IASB, and for international financial reporting we have FASB. So these are the standards board which set the US GAAP or the IFRS. Similarly, this International Valuation Standards Council, that is IVSC, is an independent non-profit organization that develops and maintains these standards. So they are being casted with the responsibility on their own. It's a non-profit organization who have come together and that develops and maintains these standards. It aims to promote high quality valuation practices worldwide. So to some extent the overall valuation has been brought into a standardization mode, and if that's achieved, then internationally, because nowadays the world has shrunk and a lot of international opportunities are being tapped by Indian MNCs as well as multinational MNCs have also started looking India as a investment hub, and with that intent some kind of a standardization has been brought into. So mandatory nature of IVS. So IVS are the international valuation standards. So to state that a valuation complies with IVS, it must strictly follow all mandatory requirements of the standards. These are not optional. Adherence is required for official compliance. So all valuation professionals have to adhere with the IVS, International Valuation Standards. Now typically they are principles based elements. Some components of IVS are not prescriptive. Instead they outline key principles and concepts that must be considered when performing valuations, allowing professional judgment to be applied wherever appropriate. So typically they are the contents or the guidelines that have been prescribed in the valuation, various valuation standards. Which are those, etc. We will see that. So the overall framework or the crux of the valuation standard will be always principle based. So it will give the thought how to be applied, how to be implemented, how to be followed will be left on to the professional judgment of the person or the valuation professional as to how to apply it wherever appropriate. So in short, it is principle based elements are there. Some components of IVS are not prescriptive. So not prescriptive means it will not spell out that okay, this is the way it has to be done. It will give you the guiding principle, and thereupon it will be left on to the professionals to use their judgment to apply it as may be appropriate. So that's what it means. Then implied compliance. So if a valuer claims that their valuation follows IVS, it implies that all relevant standards and requirements by the IVSC have been thoroughly followed. So there has to be a implied compliance. So once the valuer claims that he has followed the international valuation standards, it implies that all the relevant standards have been and requirements have been complied thoroughly to the with its proper letter and spirit also. Departure clause. A departure clause typically occurs when local laws or regulations override certain IVS requirements. In such cases, compliance with the legal framework takes precedence, but the departure must be clearly disclosed and justified. So in a way, departure clause is something which the standard has some divergent views vis-a-vis the local laws or regulations, and in such case the departure occurs when local laws or regulations override certain IVS requirements. So maybe IVS is mentioning to apply certain guiding principles in a particular fashion, whereas the local laws and regulations may be mandating it to be done in a different fashion. In that case, the local laws and regulations will override the IVS. So local laws and regulations will have to be followed and not the IVS if there are divergence concepts between the two. And in such case, wherever there is such kind of a departure from the international valuation standard, then necessary disclosure and justification must be given. So in short, in such cases, compliance with the legal framework takes precedence. So legal framework means local laws and regulations will override, but the departure must be clearly disclosed and justified. So the core principles of valuation under IVS are, these principles are foundational for all valuation assignments and ensure reliability, professionalism and accountability. So ethics are precisely looked upon, and these be, just a second. Yeah. So ethics as the foundational, obviously, for all standards, whether they are accounting standards, secretarial standards, costing standards, auditing standards, or valuation standard, the foundational and fundamental principles will be always ethics. So ethics, in such case, valuers must uphold ethical standards including integrity, objectivity, impartiality, confidentiality, competence and professionalism. So these are the what you can say pillars of ethical standards: integrity, objectivity, impartiality. So integrity means he has to be honest, he has to be true to the assignment, he has to be true to the intended expectations of the users who will be looking at the valuation. So true to yourself, so that's what integrity or and honesty would mean. Fair and disclosive. Objectivity means with the purpose for which the valuation is being done, he should follow that objective. Impartiality means he should not be biased, he should be unbiased, he should not be tilted towards a particular way only. Confidentiality is because while valuation is being done, lot of data and information is being provided to the valuation professionals, and he has to ensure that such data confidentiality and data privacy and data protection has been done by him. Competence, of course, he should be competent enough academically, experience wise also, and eligibility wise to do the valuation of the assets or the assignment at hand. And professionalism, yes, he has to be professional in the approach. Ethical conduct is key to guiding public trust in valuation outcomes. So once the ethical standards are followed, obviously the public trust and confidence will be always built upon the valuation and professional and the valuation exercise also. Second foundational core principle is competency. So valuer must possess the requisite technical skills and knowledge for the specific assignment. He must demonstrate they are qualified and capable at the time the valuation is submitted. So that's what competency would mean. Third core principle is the compliance. Give me a second. Yeah. So third is the compliance. So compliance means typically adhering to, so the valuer must clearly identify and comply with the relevant published valuation standards used for the assignment, and transparency should be maintained regarding the standards being followed. Standards followed is mandatory. So these are the two key aspects of compliance, that he has to clearly identify and comply with the relevant published valuation standards used for the assignment at the same time. So that's disclosure and transparency. So third is the compliance as a core principle of valuation. The fourth core principle is the basis of value. Just a second. Yeah, so the basis of value, valuer must select the appropriate type or standard of value. Example, market value or fair value, whichever way the valuer is taking a call and selecting the appropriate type or standard of value. The basis must be used, must be clearly defined or properly cited in the valuation report. So that's what the disclosure and transparency comes into. Whatever basis of value that he is considering, it should be disclosed and transparently mentioned specifically that is cited in the valuation report itself. The date of value is very critical, so that the effective date of valuation, that is a specific point in time the valuation reflects, because at times the asset will be so volatile, so dynamic that the valuation may change. Typically the valuation of financial assets, the timing is very important, and hence therefore the effective date of the valuation, that is a specific time, a specific point in time the valuation reflects, must be disclosed, because if at all any outdated value is being considered, it might turn out to be irrelevant and misguiding for the valuation exercise also. So the effective date of valuation must be cited. The date of valuation is reported must also be clearly stated. So these are the date of valuation to be mentioned. Assumptions and conditions. So any significant assumptions or limiting conditions that affect the valuation, or whatever the valuer or valuation professional considered or been told, been informed by the client also, those significant assumptions or limiting conditions that affect the valuation must be transparently disclosed. These factors could impact the valuation outcome and must be made known to the users, because the valuation then accordingly will be viewed by the users according to the assumptions and conditions that have been followed. So the valuation will get a context in terms of the assumptions and the conditions that are being followed, that have been followed by the valuer. So those have to be disclosed to the users. Sorry. Then comes the another set of core principles, the intended use, intended users. Now what it is, let me just take a pause for beautification of it. Yeah. So the intended use, the valuer must specify the intended use of the valuation, example financial reporting, transactions, or legal, etc. This ensures the valuation is fit for purpose. So then with the one can correlate the valuation with the intended use for which the valuation exercise is being done, and then it gives a meaning to the whole valuation exercise also. As long as the intended use of the valuation is not known to the users or to the readers of the valuation report also, many a times the valuation exercise becomes futile, and therefore the valuer must specify the intended use of the valuation, and this ensures the valuation is fit for the purpose. Obviously the users also then find the relevance that okay, the valuation which has been arrived at is fitting or is fit and proper for the purpose for which it is being done. The intended users, so the report must clearly state who the intended users of the valuation are. Now this is again critical, because in a way who should be looking at these reports and who should be considering these reports should be clearly mentioned, and then the intended users will look at the valuation report with that specific intended use only. So this clarifies who can rely on the valuation findings. Ninth core principle of valuation is scope of work. So valuers must define and conduct a scope of work appropriate to the assignment. The scope must be sufficient to produce a credible and reliable valuation. There are few more, so we are going through the various core principles of valuation itself, and you and I as a valuation professional should be very well aware of this, because these are the foundational or fundamental principles of valuation exercise. And if you have seen any valuation report, most of the time these core principles are covered in the valuation report. So 10th core principle, identification of subject or valuation. The subject, that is the property, business, asset being valued. So the subject matter of valuation should be clearly and accurately identified and should be mentioned in the valuation report. Ambiguity in what is being valued must be avoided, obviously, otherwise the whole valuation exercise becomes futile. Then comes the data. Yeah, this is very important. So valuers must use relevant, reliable data inputs presented in a clear and transparent manner. Proper data use supports the credibility of the valuation. Valuation methodology. The correct valuation methods must be selected and applied based on the nature of the asset and assignment. Methodologies must be used appropriately and consistently. So this is how the valuation methodology also has to be disclosed in the valuation report. The correct valuation method should be followed and selected, and based on the nature of asset and the purpose or the assignment in hand. So now, so these are the, in short, one can say 11, not 11, 12 core principles of valuation. I'll quickly repeat: ethics, competency, compliance, basis of value, date of value, assumptions and conditions, intended use, intended user, scope of work, identification of subject of valuation, data, and valuation method. Now all these I have tried to crisply, concisely put across in this PPT. Obviously, having followed, as my practice had been, I have followed the study material provided by the Institute of Cost Management Accountants of India only, because it's a beautiful material, fully exam oriented and knowledge oriented also. It can as like a reference material for life, for all the valuation professionals also, and therefore in a way all these principles are there in that chapter or the study material that has been provided by the institute. So these were the core principles of valuation. Then we move ahead. Now we are slowly getting into each and every valuation standard. So IVS 101 typically is about scope of work. So there will be again this has been elaborately mentioned or covered in the study material of the institute. I have tried to again summarize it in a concise way and put across the relevant concepts over here of each and every standard that has been covered in the study material. So if at all someone wants to study more deeply that particular standard, then he should refer to the study material itself. I have tried to concise it in some fashion so as to help you to understand the topic for the examination perspective. So 101 IVS is about scope of work. Now this standards ensures clarity, transparency and alignment between the valuer and client. So in a way the first few lines are the purpose or the objective of the scope of work of the IVS 1. This IVS 101 ensures clarity, transparency and alignment between the valuer and the client, forming a strong foundation for delivering a credible and compliant valuation. So scope of work, so in a way it's a binding force between the valuer and the client, and it lays the strong foundation for delivering a credible and compliant valuation from the valuation professional to the client. The purpose and importance, the scope of work, also referred to as the terms of engagement or TOE, defines the key parameters and framework of a valuation assignment. It outlines critical elements such as what is being valued, why the valuation is being performed, responsibilities of the involved parties. So these are the purposes of why the valuation, or what are the critical elements that are covered. Just a second. Yeah. Again, this scope of work typically is the foundation of any assignment, and it sets the framework within which the assignment has to be done. It spells out the terms of engagement, why a particular client is engaging a particular valuation professional, all those terms and conditions of the engagement of such a valuation professional, and valuation professional agreeing to the requirement of the client or the conditions of the client are covered under, and how it should be, how the scope of work should be defined, how it should be what you can say translated into a agreement or a writing or a terms of engagement for that purposes, this valuation standard is very useful and critical. It ensures that the valuation process is aligned with the intended purpose and the valuation advice provided is appropriate and reliable for that use. So these are the purposes and importance of IVS 101. Communication with the client and intended users. So valuers must clearly communicate the scope of work before finalizing and reporting the valuation. So this is the, one can say as simply a memorandum of understanding between the client and valuation professional. So therefore there has to be clear communication between the both the parties, client and valuation professional also, about the scope of work before finalizing and reporting the valuation per se. The valuer must ensure that the client and any other intended users fully understand the deliverables and are aware of any limitations on the use of valuation. So this is the clear cut. That's why I say it's like a memorandum of understanding between the two parties, client and valuation professional. Then comes the essential elements of the scope of work. The scope of work must include the following details. Sorry. Yeah, the scope of work must include the following details. So the essential elements of scope of work are identify identity of the valuer, sorry. Just a second. Identity of the client. So in short, the scope of work will define who is the valuer, what is his background, what are his details, whether it's an individual or a firm, what are the expertise of that valuer, etc., etc. So in a way, identity of the valuer. Similarly, the identity of client will be also given. It will mention the what all businesses the client is doing. So identity of valuer will include the name and credentials of the professional conducting the valuation. Identity of the client will include the individual or organization commissioning the valuation. Identity of other intended users, if any. Any other parties authorized to rely on the valuation report will also be specifically mentioned in the scope of work. Then comes the assets being, sorry, I am taking some time to clean it up also because in a way I have hurriedly done this. So it has to look presentable also at the same time and uniform also. Till then you can read, of course. Then the other fourth essential element to be covered in the scope of is the asset being valued should be clear. So clear and specific mention of the clear and specific description of the assets subject to valuation. Example, whether you are valuing real estate, business, plant and machinery or financial assets, whatever it may be. Then the valuation currency, so the currency in which the value is being expressed, that is also to be specified, so that the valuation report will be viewed accordingly, because this valuation report may be looked at internationally also, and with that purpose the outsider or the foreigner must be able to figure out in what currency the valuation is being done, so that he can accordingly consider it and accordingly maybe translate it into his currency. So that's the intent of giving the valuation, whether the value is being given in US dollar, pounds or Indian rupees or whatever the currency that is being expected from the, or that is being followed by the client. So again, that has to, valuation currency has to be mentioned in the scope of work. Then comes the basis of value used is to be mentioned. The valuation date, again the core principle of valuation standards. The nature and extent of the valuer's work and the limitations also have to be mentioned. So these are the essential elements that we are seeing. So basis of value used, the type or standard of value being applied, example market value or the fair value, valuation date, the effective date for which the valuation is applicable, the nature and extent of the valuer's work and limitations, the scope of analysis, site visits, inspections and any limitations on what could be done, example restricted access to information of premises at times, all those limitations and how the context in which the valuation is done should be specifically mentioned. Then comes the nature and sources of information that has been relied upon. So those also have to be disclosed. So these are the elements of essential elements of scope of work. Then the significant assumptions and or special assumptions that have been considered. So the nature and sources of information relied upon, it will include a list of key data sources, whether balance sheet, P&L or any management reports that have been considered, or any external reports that have been considered, or any other outsiders reports that have been relied upon. All those nature and sources of information that have been relied upon for the purpose of valuation exercise will have to be disclosed out over there. So a list of key data sources, third party reports or client provided information used in the valuation should be mentioned. Then another element of scope of work is the significant assumptions and or special assumptions. Any assumptions, example going concern, future market conditions that are critical to the valuation outcome must be spelled out. The type of report being prepared, the format and style of the report, example summary, detail, verbal report. So there has to be some index how the report has been prepared. Or rather how the final report will be delivered. So that's again the scope of work, whether it should be in a summary form or it should be detailed. Again that has to be mentioned and becomes the essential element of scope of work. Restrictions on use, distribution and publication, guidelines on who can access, share or publish the valuation and under what circumstances, compliance with IVS, so a statement confirming that the valuation will comply with all relevant international valuation standards and that the valuer will assess the appropriateness of all significant inputs also has to be mentioned in the scope of work. So So these were the specific essential elements to be covered in the scope of work, and that's what the IVS 101 is. Now we move to the next IVS, that is IVS 102, which is about investigations and compliance. Now the objective of this IVS 102 is ensures that the valuations are rigorous, evidence-based and defensible. Stakeholders can trust the results, knowing proper investigation and valuation procedures were followed, and the valuation process remains transparent and professional even in cases of limited data or investigative constraints. So the general principle over here is that all valuation assignments, including valuation reviews, must be carried out in full compliance with the IVS principles, the specific purpose of the valuation, the agreed terms and conditions outlined in the scope of work. Then appropriate investigations would mean the depth and the type of investigations conducted must be spelled out. So the depth and type of investigations conducted must be relevant to the valuation purpose, appropriate for the basis of value being used, example market value or fair value, sufficient to support a credible and defensible valuation conclusion. Then the evidence gathering has to be disclosed. So valuers are expected to gather adequate supporting evidence through a variety of methods, including physical inspection wherever feasible, inquiries with relevant parties, computations and calculations, market and data analysis. The goal is to build a well-supported valuation based on the objective and verifiable inputs. So this is the underlying intent. Limits on investigation. So a valuation professional, how much extent of investigation and compliance he has done, that is to be specified. So so these standards gives the framework for how much of investigation and compliance is to be done, so as to give comfort to the outside world whoever will be referring to the valuation report. So the limits on investigation, in some cases the extent of investigation may be limited due to client instructions, legal restrictions and practical constraints also. So any such limitation must be explicitly agreed upon and disclosed on the report, in the report, as they can affect the credibility of the valuation. Then comes the use of third-party information. So the information provided by management, owners or third parties must be considered and analyzed carefully, corroborated or cross-verified wherever possible through independent sources or evidences. If the reliability of such information is uncertain, the valuer must exercise professional skepticism, decide whether and how to incorporate such inputs into the valuation, clearly disclose any reservations or assumptions made due to the questionable reliability of the data. So whenever a valuation professional is using third-party information, these are the caveats or the disclaimers that he should follow, or he should, or the in a way prudence that he should follow while considering the usage of third-party information. Then comes the documentation and record keeping. So the valuers are required to maintain a record of all work performed, key findings and analysis, evidence relied upon to reach the final conclusion. So these records must be retained. Just a second. Yeah, these records must be retained for a reasonable period after assignment completion, taking into account the statutory obligations, regulatory requirements and professional standards. So this is about documentation and record keeping. Then comes the IVS 103. So IVS 102 ends over there with the documentation and record keeping. IVS 103 talks about reporting. So this standard, the objective of this standard is to ensure valuation reports are complete, coherent and user focused, capable of being independently understood and assessed, and supportive of internal decision making by stakeholders. So the purpose of reporting should be clear. The valuation report must clearly communicate all essential information to allow intended users to properly understand the valuation outcome, be aware to the context, assumptions and methodology adopted or involved. The aim is to ensure transparency, clarity and credibility in how valuation results are presented. Because it's all about reporting, the minimum reporting requirement in a way is required to be detailed out in the and to be followed in terms of whenever reporting is being to be done. So this standard is to be referred in short. Whenever scope of work is to be done, IVS 101 is to be followed. Whenever third party investigations or compliance is to be done, then IVS 102 is followed. So this is how the standards are required to be followed depending on the area upon which the focus is. That standard, if at all there is any explicitly mentioned IVS, then that IVS has to be followed to the with proper letter and spirit. The minimum reporting requirements. So in scope of work, perform a summary of what the valuer did, including any limitations, investigations or restrictions during the process. Helps users assess the depth and reliability of the valuation. Intended use, the specific reason or objective for which the valuation is being conducted. Example, financial reporting and investment analysis, legal proceedings, ensures the valuation is interpreted correctly for its actual purpose. Intended users, so clearly identify the individuals or organizations authorized to rely on the report, helps prevent unauthorized or misinformed usage. Purpose of valuation, describes the broad context or event prompting the valuation. Intended users, then purpose of valuation, describes the broad context and event prompting the valuation. Example, merger, loan, audit requirement, etc. Clarifies how the valuation will be used in decision making. Approaches adopted, refers to the overall valuation approaches applied, such as market approach, income approach, cost approach. Shows how the valuer structured their analytical framework. So it gives the context and the methodology is required to be reported. Then comes the methods applied. Sorry, just a second. 5, 6, yeah. So methods applied, specific valuation techniques used within the broader approaches. Example, discounted cash flow, comparable sales, indicates the technical process used to derive value. Key inputs used, the critical data or variables used in valuation calculations. Example, market prices, discount rates, or forecast. Inputs must be relevant, reliable and disclosed transparently. Assumptions made, list all material assumptions. Example, going concern, market conditions, regulatory environment. Users must be aware of the hypothetical conditions on which the valuation is based. Other few things of minimum reporting requirements includes conclusion of value and principal reasons. So the final value estimates reached by the valuer has to be disclosed or reported rather. Must include a clear explanation of the reasoning and rationale behind the conclusion. Yeah, so the conclusion of valuation and principal reasons, the final value estimates reached by the valuer must include a clear explanation of the reasoning and rationale behind the conclusion. Date of the report, the date of the report was finalized and issued, which may be different from the valuation date, important for tracking changes in market conditions or regulatory context. Then comes the IVS 104, which is the basis of value. So it ensures that valuers choose the right basis and premise for the valuation, are transparent about inputs, assumptions and intended use, provide valuations that are reliable, consistent and contextually appropriate. So that's the objective for which the IVS 104 is drafted or framed. Let's see the definition and importance of this standard. The basis of value, also known as standards of value, define the fundamental assumptions or premises on which the valuation result is based. Selecting an appropriate basis of value is critical as it influences valuation methods used, inputs and assumptions applied, and the conclusion of value. So types of basis of value. So there are various types and types of basis of value. So IVS A defined basis of value. Just a second. So these are the probable bases of value that are being considered over a period of time by the various valuation professionals. So what is the basis of value that has been considered by a particular valuer that is required to be mentioned, or these are the values to be followed if at all the basis of value is to be followed. Yeah. So market value is one of the bases of value. Now this market value in a way is the price for asset or liability exchange between knowledgeable willing parties in an arm's length transaction without compulsion. So these are the in a way definitions also of market value. Market rent, so it's a estimated rent for leasing real property under normal conditions. Equitable value of fair price between identified parties considering mutual benefits or disadvantages. Investment value or worth, value of an asset to a specific owner for their unique investment or operational purposes. Synergistic value, so this value derived from combining assets exceeding the sum of individual values. Example, mergers. Liquidation value, value realized when assets are sold piecemeal either under orderly, that is normal time, or forced, that is rush sale conditions. Other recognized non-IVS basis of value. So there are two categories of basis of value. One is the IVS based values and second are the non-IVS basis of values. So non-IVS basis of values are, just a second. Fair value as defined by IFRS, fair market value as defined by OECD, that is Organization of Economic Cooperation and Development. So it's a international body. Fair market value per US IRS and fair value for legal and statutory purposes. So these are other recognized non-IVS basis of values. Premises of value, assumed use. So these describe how the asset is used under the chosen basis of value. Common premises includes highest and best use, that is HBU use, what that provides the maximum value and is physically possible, legally permitted, financially feasible and most profitable. That will be the highest and best use. May be current use or involve conversion. Then the second premises of value or assumed use is current existing use, reflects how the asset is currently utilized, may or may not be the HBU. Third is the orderly liquidation, sale under reasonable marketing time with seller compelled to sell as is where is. Or sale under compulsion without marketing where due diligence may be limited. Entity-specific factors and synergies. So let's see what are the entity-specific factors and synergies that are part of basis of value. For most bases, especially market value, entity-specific factors are excluded, such as unique tax benefits or burdens, proprietary rights, unique operational advantages. Synergies are considered under synergistic or investment value, not market value. The key considerations in valuation includes assumptions. For all assumptions, especially special ones, must be reasonable, evidence supported and relevant to the purpose. Transaction cost and taxes excluded in most bases of value. Do not account for buyer seller cost or taxes unless explicitly required. Then comes the IVS 105, which is the valuation approaches and methods. So valuation must consider appropriate approaches and methods depending on the asset type, available data and the basis of value. So the three main valuation approaches are market approach, income approach and cost approach. The valuers may apply one or multiple approaches, must justify their choice of methods, should not average results if using multiple approaches, but reconcile the differences logically, must maximize use of observable market data. Now let's see one by one approach. The market approach and the key factors over there determines value by comparing the subject asset to identical or similar assets with known prices based on the principle of substitution. Best use when this market approach is best used, it is best used when recent reliable arm's length transactions exist for identical or similar assets. Asset is actively traded in a public market. Use with caution when data is outdated or incomplete. Comparable require subjective adjustments and market data involves non-arm's length or distressed sales. Common methods, comparable transactions method, guideline publicly traded comparable method. So these are the common methods typically which are being used in market approach. Then comes the cost approach. So indicates value by calculating current cost or current cost to recreate or replace the asset, less depreciation and obsolescence, based on the principle that buyers won't pay more than the cost of an equivalent asset. Best use when asset can be easily and legally recreated, asset is unique or not income producing, basis of values is replacement cost. Use with caution when legal or time constraints limit replication. Used as a reasonableness check on other approaches. Asset was recently created with reliable cost data. Common methods, typically replacement cost method, wherein estimates cost of a similar asset with equivalent utility. Reproduction cost method estimates cost to replicate the asset value at the exact asset. And summation method, wherein values components separately then adds them. Other key points, price from an active market is the strongest evidence of value. In some cases, client and valuer may pre-agree on methods, but limitations may lead to non-IVS compliant valuations. Asset standards and valuation methods must align with economic principles and market realities. Asset standards. So these standards provide specific guidance on valuation of different types of assets and liabilities, ensuring consistency and clarity across asset classes. So in a way, the study material has briefly touched upon these various standards. So IVS 200 talks about businesses and business interest. It covers valuation of entire businesses or ownership interest. Example, equity shares, partnerships, used for mergers and acquisitions, investment, restructuring or financial reporting. IVS 210 talks about or deals with intangible assets, deals with valuation of non-physical assets such as intellectual property, goodwill, brands or licenses, essentially in tech, pharma and brand heavy industries. IVS 220 non-financial liabilities provides guidance on valuing obligations that are not financial in nature, such as environmental or warranty liabilities, often needed for compliance, accounting and risk management. IVS 230, inventory. So addresses valuation of tangible inventory assets like raw materials, work in progress and finished goods. Relevant for retail, manufacturing and liquidation scenarios. IVS 300 is plant and machinery. Focuses on valuation physical operational assets such as equipment, vehicles and industrial machines. Common in asset-backed lending, insurance and sale of equipment. IVS 400 deals with real property interest. So these are the various asset-based standards that are being prescribed. So if inventory is to be valued, then IVS 230 has to be considered. If plant and machinery is to be valued, then IVS 300 is to be considered. In case of real property interest, then IVS 400, which covers valuation of land and buildings, including ownership and leasehold interest, used for real estate transactions, mortgages and taxation. Then IVS 410 talks about development property, applies to property under construction or development, including land with development potential, used by real estate developers, investors and lenders. IVS 500, financial instruments. It provides guidance on valuing financial assets and liabilities like stocks, bonds, derivatives and structured products. Critical for banks, funds and financial reporting. Then there is this specific rule 11 UA, sub-rule 1, sub-rule C, fair market value, FMV of shares and securities. So FMV, so these are income tax rules typically. So FMV of quoted shares and securities, now these deals with the financial assets in a way. So if FMV is the fair market value of quoted shares and securities, obviously if transacted on a recognized stock exchange, the FMV is equal to transaction value as recorded on the exchange. If not transacted on a recognized stock exchange, then FMV is the lower of the lowest price on a recognized stock exchange on the valuation date and the lowest price on the preceding date when traded if no trading occurred on the valuation date. Again, FMV of unquoted equity shares, FMV is calculated using the following formula. FMV is equal to A plus B plus C plus D minus L into present value divided by the price earning. So A is the book value of all assets excluding jewelry, artwork, securities, immovable property, adjusted for income tax paid into bracket less refund claim, non-representative assets like deferred expenses, market value of so B is market value of jewelry and artworks, valuation report from registered valuer. C is the FMV of shares and securities as per rule 11 UA. D stamp duty value of immovable properties. L book value of liabilities excluding specific non-deductible items like share capital, reserves, contingent liabilities, unpaid declared dividends, etc. Present value is equal to PV is equal to paid up value of the specific equity shares and P is the total paid up equity share capital. Alternate method allowed. FMV can also be determined using the discounted cash flow method by a merchant banker. C, so we are looking into the fair market value of shares and securities. So FMV of unquoted shares and securities other than equity shares. In such case, FMV is equal to the price of the asset. Price the asset would fetch in the open market on valuation date, and a valuation report from a merchant banker or accountant can be obtained for support. Then comes the rule 11 UAB, that is about determination of fair market value for inventory as per section 28 subsection 6A. So FMV of inventory upon conversion to capital asset, in such case immovable property, that is land and building. So FMV is equal to the stamp duty value as adopted, assessable by central or state government on the date of conversion. Jewelry, artwork, shares and securities as per rule 11 UA will mean the FMV is equal to value determined as per rule 11 UA. Valuation date is equal to the date of conversion of inventory to just a second. Or other types of property not covered above, FMV is equal to the price the asset would fetch in the open market on the date of conversion. Then comes the applicability of Ind AS. So there is Indian Accounting Standard 111 which talks about fair value measurement. Now applicability of this Ind AS applies to all Ind AS that require or permit fair value measurement. Example, Ind AS 105, 107, 109 requires permits fair value measurement, and then in such situation wherever the Ind AS as per Ind AS 105, 107 and 109, if at all fair value measurement is to be done, then that such fair value measurement has to be done as per Ind AS 113. That's what it means. Not applicable to standards that prescribe their own valuation method. So Ind AS 102, 17, 2, 36, 19, etc. specifies their own valuation methods. In such situation, fair value measurement as prescribed by Ind AS 113 is not required to be applied. So this Ind AS covers measurement like fair value less cost to sell and related disclosures. Definition of fair value: price received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement rate. That is the definition of fair value. Key concepts: orderly transaction, exposure to market before valuation, not a distress and forced sale, market participants knowledgeable, able, willing and independent, principal market, market with highest volume of trade, most advantageous market, that is MAM, market with highest price in absence of principal market, inputs for valuation: level 1 quoted price in active markets, example listed shares; level 2 observable inputs like prices of similar assets like in less active markets; and level 3 unobservable inputs, example internal forecast and assumptions. Valuation techniques that are prescribed in Ind AS 113 for fair value measurement are the market approach based on market transactions of identical comparable assets, income approach based on discounted cash flows and income generation, cost approach based on replacement cost of the assets service capacity. The technique selection criteria is relevance to context, availability of data, preference for observable inputs, use of multiple techniques if needed for accurate valuation. Changes in valuation techniques permitted if it leads to better representation of fair value due to new markets or data, changes in market conditions, better valuation practices. Disclosures that are required to be given in Ind AS 113 about fair value measurement are extent of fair value usage, extent of fair value usage, techniques, inputs, assumptions used, impact of level 3, impact of level 3 fair value on profit and loss account or OCI. So that's what the disclosures that are required in Ind AS. Now there are few illustration example that have been prescribed in the study material. So that again I have tried to summarize it. Investor Pankaj, so example 1 talks about investor Pankaj buys unquoted shares, use transaction price as baseline adjusted for market changes or company performance. Solve case study scenario: a company with negative net worth wants to issue more shares, valuation needed for further issue. Approach that is used is the net asset value, that is NAV. NAV per share is equal to assets minus liabilities divided by number of shares. Now, so typically this illustration is there in more detail in the study material after the chapter or within the chapter itself, chapter number 5, which is about valuation standards. I have just tried to concisely capture it over here. Maybe the presentation may be wrong, but the essence is covered, or the key points are being covered. Valuation rationale: income approach not reliable due to unstable financials; market approach, no comparable listed companies; and cost approach, that is NAV, used based on the balance sheet figures. So relevant Companies Act provisions, section 62 talks about shares issued. So section 62 shares issued based on the registered values report, and section 53 prohibits issue of shares at a discount to face value. Sorry, this is a blank slide by mistake that has come up. Just a second. Yeah. So with this, the chapter per se of the study material ends. However, as my practice had been, I have covered the principles or the concepts that are being covered in the short question and answers and the long question and answers that have been covered below the chapter, at the end of the chapter of the study material per se. So in short question and answer 1, the objectives of SURFACE Act has been covered. It provides a legal framework for securitization and asset reconstruction. It enables enforcement of security interests without court intervention. So in a way, these short question and answers are overall on the module itself, which are being covered. So in the chapter, at the end of the chapter 5, if you see, there are short question answer and long question answer, which in a way are about the entire module, all 5 chapters itself. So the essence of those short question answer and long question answer, I have tried to summarize it over here. So short question answer 1 talks about objectives of SURFACE Act. So SURFACE Act as chapter 4, I have elaborately covered. The objectives of that act are the legal framework for securitization and asset reconstruction. It enables enforcement for security interests without court intervention, allows bank to take over collateral assets for NPA recovery, reduces NPA burden on the banks and financial institutions, and enhances financial stability. Then short question and answer 2 talks about rights and responsibilities of bank. So banks can in a way take possession of collateral, sell, lease or manage collateral, direct the borrower's debtors to repay the bank. These powers enable efficient and timely debt recovery for the banks. In short question and answer 3, some key definitions have been covered. One is the securitization conversion of loans. Sorry, just a second. Sorry. Yeah, my mistake. Now this unfortunately in the copy paste hurry, I guess the chapter 5 question and answers have got copied. So unfortunately, after the chapter 5, there are no specific question and answers that are there. Let me just once check with my presentation of that specific chapter also, whether the same have got copied per se. If yes, then the chapter ends over the Companies Act provisions itself. Yeah, it's my mistake. The same this thing has got copied. Yeah. Sorry. So I need to delete this because it's about the previous chapter only. That's what I was wondering, why these repeated things are coming up. Yeah. So the last portion of the chapter 5 was the valuation standards, was relevant Companies Act provision. In that section 62, so again if you see the study material, there is hardly any para on the 2 sections that have been covered in the relevant Companies Act provisions in that chapter. So section 62 is about shares issued based on the registered valuers report, and section 53 talks about prohibits issue of shares at a discount to face value. So with this, in a way we end the chapter, and that's the end of the module 6 also. It's almost 8:15, so I'll quickly sum up what all has been covered in today's session, which is the valuation standard. So we started with the overview of International Valuation Standard (IVS). We covered the definition, the governing body, which is the International Valuation Standards Council, the mandatory nature of IVS also we have tried to. Then we saw that the overall international valuation standards are principle-based elements, wherein in a way the concepts that must be considered when performing valuations, allowing professional judgment to be applied where appropriate. Implied compliance: if a valuer claims that their valuation follows IVS, it implies that all relevant standards and requirements by the IVSC have been thoroughly followed. Departure clause, if at all there are local laws and regulations that have a different view in terms of the valuation standards or valuation per se, then the local laws and regulations will override the valuation standards, and in such case the departure clause is to be considered, wherein disclosure is to be given. In such cases, compliance with the legal framework takes precedence, but the departure must be clearly disclosed and justified. Then we saw the core principles of valuation under IVS, wherein the core principles are foundational for all valuation assignments and ensures reliability, professionalism and accountability also, like ethics, competency, compliance, basis of value, is date of value, assumptions and conditions, intended use, intended users, scope of work, identification of subject of valuation, data, valuation method. Then we saw each and every standard that have been given in the study material. So IVS 101 talks about scope of work. We saw the purpose, the objective, importance of scope of work, the communication with client and intended users, how it should be clear, specific, fully understandable with the deliverables, aware of any limitations. Then we went through one by one the essential elements of the scope of work: identity of the valuer, identity of the client, identity of other intended users if any, assets being valued, valuation currency, purpose of valuation, basis of value used, valuation date, nature and extent of the valuer's work and limitations, nature and sources of information relied upon, significant assumptions and or special assumptions, type of report being prepared. Then restrictions on use, distribution and publication should be mentioned. Valuation and compliance with IVS are required to be specified in the scope of work. The general principles also that are required and expected have been covered. There are certain, then we saw the 102 investigation and compliance, wherein there are certain general principles like all valuation assignments including valuation reviews must be carried out with full compliance with IVS principles, specific purpose of the valuation and the agreed terms and conditions outlined in the scope. Then appropriate investigation, the depth and type of investigations conducted must be relevant. So the whole objective of this IVS 102 is to ensure that the valuations are rigorous, evidence based and defensible. Stakeholders can trust and results knowing the results knowing proper investigation and validation procedures were followed, and the validation process remains transparent and professional even in cases of limited data or investigative constraints. So these are in short the IVS 102 ensures or has to ensure that appropriate investigations have been considered. So the appropriate, so relevant to the valuation purpose, appropriate for the basis of value being used, example market value, fair value, sufficient to support a credible and defensible valuation conclusion. Evidence gathering, valuers are expected to gather adequate supporting evidence through a variety of methods including physical inspection, inquiries with relevant parties, computation and calculation, market and data analysis. The goal is to build a well-supported valuation based on objective and verifiable inputs. Limits on the investigation. In some cases, the extent of investigation may be limited due to client instructions, legal restrictions, practical constraints. Any limitations must be explicitly agreed upon and disclosed in the report as they can affect the credibility of the valuation. Then we saw the use of third-party information, how it should be used, how it should be corroborated or cross-verified. Then the reliability, how much reliance should be put on to the third-party information, exercise of professional skepticism, decide whether and how to incorporate such inputs into the valuation, clearly disclose any reservations or assumptions. Then documentation 102, investigation and compliance related documentation, record keeping, all work performed, key findings, analysis, evidence is relied upon to reach the final conclusion. These records must be retained for a reasonable period after assignment completion, taking into account the statutory obligations, regulatory requirements, professional standards also. Purpose of reporting, which is dealt with 103. So the valuation report must clearly communicate all essential information to allow intended users to properly understand the. So I am quickly summarizing the entire session in a way by reading through the content of the presentation that I have followed during the session. Properly understand the valuation outcome, be aware of the context, assumptions and methodology involved, The aim is to ensure transparency, clarity and credibility in how valuation results are presented. Minimum reporting requirements, scope of work performed, intended use, intended users, purpose of valuation, approaches adopted, whether market, income, cost approach, then the methods applied, key inputs used, assumptions made, conclusions of value and principal reasons, the date of the report has to be disclosed in the, and these are all the minimum reporting requirements as per 103 standard IVS, which deals with the reporting per se. 104 deals with the basis of value. So in the objective of this standard is to ensure that valuers choose the right basis premise for the valuation, are transparent about inputs, assumptions and intended use, provide valuations that are reliable. We saw the definition and importance of basis of value. Then selecting the appropriate basis of value is critical as it influences valuation methods used, inputs and assumptions applied, the conclusion of valuation. Types basis of value. IVS defined basis of value includes market value, market rent, equitable value, investment value, synergistic value, liquidation value. And other recognized non-IVS basis of value includes fair value, fair market value, fair market value, fair value. So these are, then we saw the premises of value, that is the assumed use. So these describe how the asset is used under the chosen basis of value. Common premises includes highest and best use, that is SBU, which means physically possible, legally permitted, financially feasible and more profitable. Then current, existing use, orderly liquidation and for sale. Entity specific factors and synergies we saw. For most bases, especially market value and entity specific factors are excluded, such as unique tax benefits or burdens, proprietary rights, unique operational advantages. So synergies are considered under synergistic or investment value, not market value. Just a second. Yeah, then we saw the key considerations in valuation, assumptions, transaction cost and taxes. Then 105 IVS talks about valuation approaches and methods. The three main valuation approaches are market approach, income approach and cost approach. So valuer may apply one or multiple approaches, must justify their choice of method, should not average results if using multiple approaches but reconcile differences logically, must maximize use of observable market data. Then the various valuation approaches we saw in detail. Market approach, what are the best used, when it is best used, when, and used with caution when. Common methods, comparable transactions method, guideline, publicly tradable comparable method. Then we saw cost approach. So in that common methods are replacement cost method, reproduction cost method and summation method. The other key points includes price from an active market. Some cases client and valuer may pre-agree on methods. Then we saw the asset standards. So asset-wise standards have been prescribed. IVS 200 talks about businesses and business interests. IVS 210 talks about ineligible assets, how the valuation is done. IVS 210 talks about non-financial liabilities, how the valuation of non-financial liabilities to be done, like bank guarantees, etc., or environmental liabilities. Then 230 talks about inventory. IVS 300 is about plant and machinery. IVS 400 is about real property interest. IVS 410 is about development property, that is applies to property under construction or development, including land with development potential. And IVS 500 talks about financial instruments. Then we saw the income tax rules of 11 UA, which talks about fair market value of shares and security. So how fair market value of quoted shares and securities have to be done, that have been prescribed. Then we saw FMV of unquoted equity shares, how it should be calculated. And then we saw the FMV of unquoted shares and securities other than equity shares, how they will be valued. Thereafter, the FMV of inventory upon conversion to capital asset. In case of immovable property, if converted into a capital asset, how it will be valued. Then we saw how the valuation of jewelry, artwork, shares, securities, etc. is to be done. And then other types of property not covered above. Thereafter, Ind AS 113, which talks about fair value measurement. So wherever fair value is to be considered, the measurement should be done as per Ind AS 113. So we saw the applicability of this Ind AS 113. Then the definition of fair value, which is the price received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Then key concepts typically includes orderly transaction, market participants, we saw the key concepts. Then principal market means what, most advantageous market means what. Inputs for valuation at 3 levels are there, level 1, level 2 and level 3. Level 3 is considered. Valuation techniques includes market approach, income approach and cost approach. Technique selection criteria that are involved in fair value measurement involves relevance to context, availability of data and preference for observable inputs. Use of multiple techniques if needed for accurate valuation. Changes in valuation techniques permitted if it leads to better representation of fair value due to new markets or data, changes in market conditions and better valuation practices. The disclosures that are required under Ind AS 113 about fair value measurement is to be mentioned. Then we saw the illustration example in which investor Pankaj buys unquoted shares. So use transaction price as baseline adjusted for market changes or company performance. Solved case. So scenario includes company with negative net worth wants to issue more shares, valuation needed for further issue. Approaches use is net asset value. NAV per share is equal to asset minus liability, that comes divided by number of shares. So negative NAV is equal to rupees 52.01, but shares issued at par 10 due to section 53, because no share can be issued at discount and hence therefore it has to be at par. Valuation rational. Income approach not reliable due to unstable financials. Market approach no comparable listed companies. Cost approach NAV used based on balance sheet figures. Then last of the concept in the chapter 5, which was there of valuation standard in the entire syllabus study material, has been Relevant Companies Act provision. Section 62 talks about shares issued based on registered values report, and section 53 prohibits issue of shares at a discount to face value. Thank you. So with this we end the chapters 5 and the module 6, and we are done with the session also. So Rakesh, any doubt, query? So in the next session we will start with the module 7, 8 and 9. I hope I should be able to finish the syllabus within the time frame. So I have been told to finish the syllabus, that is the rest of the 3 modules by mid of May, because your examination starts on first week of June. So I am trying to hard to finish off the syllabus and module 7, 8, 9. So maybe in the coming sessions I might reshuffle the modules also. So I might take 9 first, 8 later, or 7 thereafter, or I may go with the sequence. Let me see, let me figure out, and we'll see in the next session. Thanking you. Signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session. Bye bye. Thanks.